Welcome to TMS Insights, early May 2018, which means it's time for the budget, but it's also time to bring you up to date with a lot of things that have been going on in the market. The budget, well, it's budget eve actually, and Ben's very excited here. And we're going to move into a budget session later in the week for you. So today, we're just going to be talking about some of the updates in the market, Ben, containing the excitement about the budget. What's been really exciting...
I hope you're going to be a part of it.
Of course.
Yep.
What's been really exciting is the April performance of the share market.
Yeah.
A great month for the market. We haven't brought in insights to clients for a while, so we've got quite a lot of stocks to talk about. But really, April is often a good month. It was a particularly good one in the Aussie market.
Yeah, we normally see, I think April is the second strongest performing month of the year historically. May to that sort of September period is normally a bit iffier. Not every year. Last year was actually quite a good period.
Yeah.
But we've certainly seen a run, and I guess, Jeremy, that's been kind of fueled in somewhat by a bit of a rally in the banks that were pretty weak. And the resource stocks generally have held up well. And we've seen some really good moves in the mid-cap sector.
Right.
But there's been a lot of trade. It's quite a quiet March, but a lot of trading updates this month, in particular in the last week or so.
Definitely. So let's get into them. Bank reports have come out. Stocks in the banking space going ex-dividend. The dividends were good. The earnings were okay overall.
Yep. Yeah.
But everybody's been really worried about the Royal Commission. So in a summary sort of point, were there any real opportunities that came out of this reporting?
Well, I think you could probably look back and say the banks got a bit oversold on negative sentiment a week or so ago. But although the results have come out and they have proven to be a little bit better than what the market was anticipating, there still isn't a lot of earnings growth there. There's no dividend growth. And we know that there are regulatory sort of, challenges for them. Yeah. So to me, it's still more of the same, where they're going to range trade. You'll get a great yield. And there'll be periods where it's a good time to buy them, probably periods where there's a good time to let a few go. Yeah. And generally not a lot of overall growth.
Westpac better in the earnings growth than the others?
Yeah, definitely. And interesting that, we saw this UBS downgraded Westpac right before the result, went to sell from a buy, which led to quite a decent sell-off on not a lot of information. But the actual result was pleasing, I thought.
And trying to give a longer-term range forecast here, banks aren't going to look the same in a couple of years' time.
No.
We're being used to these multifaceted financial organisations. They're largely going to shrink that back to a savings and loans organisation with corporate arms as well.
Definitely. And they're going to become, I would say, incrementally safer businesses to be invested in, but they're probably not going to have the returns that they've had over the last couple of decades. I think probably fair to say. The other thing I would say, Jeremy, is... with the sales of different units that all the banks are embarking on, we're probably going to see some sort of capital returns or special dividends over the next few years. Colonial First State, MLC, et cetera, the banks are flush with cash and they're not going to have a lot of things to do with it. Yeah. So, that might be attractive.
And let's not leave that without mentioning Macquarie, which reported as well and does often get missed or separated from the others. It's been the standout performer. By
a mile. And, I still think it looks pretty good buying. It doesn't look overly expensive. The yield is still very attractive. And, it grew its earnings per share by 16% versus between 3 and 6% for the banks. But we really shouldn't compare it to the banks anymore. It's a very different business these days.
Now, Macquarie also, as an equities group, hosted a stack of companies last week, and they were mid-cap, large-cap companies, and we got some earnings updates and some guidance. Now, a lot of those companies reported really good signs for us, Ben. Yeah. A couple not so good. Let's just go through a few and we'll give some colour to the clients about that. Challenger. Again, we've loved this company. Yep. Its share price declined at the start of the year. It was a good update. The company looks in good shape.
Yep. Look, a good update, nothing new. Yeah. But despite that, we saw a massive kick in the share price post the update. I just think there's been some selling across the entire financial sector in Australia. So that's all the fund managers, et cetera, and except for Macquarie. And they, whatever the CEO said last week has put to bed any concerns that some obviously had out there about Challenger. I think it could be a winner out of sort of the budget out tonight. But long term, there's a very clear path to growth, and I think we both agree it's a good buy at these levels.
Good buy at this level. So Magellan and Platinum, while we're talking fund managers, both have been sold down. Some great performance as a result of the better markets for them. But in the case of Magellan, a little outflow in the month of April?
Yeah, so there was an outflow there, but the investment returns offset it, more than offset it. And I think they're up to $66 billion in FUM now. Platinum's at 28, I think, and there's increased by 800 million through the month. So the share price movements have been strange because there hasn't been a lot of change in the fundamentals.
It's funny that.
Yeah.
Now, Fairfax and Domain being the demerged entity of Fairfax, both gave an update last week at the Macquarie conference, and they were both very well received.
Yeah, you'd have to say again, Fairfax was probably the highlight.
Yeah.
Ironically, because as the Domain business, we were really attracted to. But it's not just Fairfax. There's this, Nine has hit an all-time high again today. WES Media. These guys are reinventing themselves, and we're starting to see some pretty good returns coming out of them. So I think there's still reason to stick with both those companies. And Domain's update was good. I don't think it's on the same path as REA at the moment, but and still CEO-less, but still looking pretty good.
Now, you mentioned REA. They made an acquisition only a week or so ago. That's been well received. They've been hitting record highs.
Yeah, and I think the big thing here, Jeremy, of course, is the increase in volumes of houses on the market. So we saw Morgan's, well-regarded analyst put out a note today saying that the Premier listing, which is one of the key things for REA's business these days, Premier listings, 44% more listings last month than the same month 1 year ago. That's the extraordinary number, and that's fueling very strong growth, I think, in the underlying business.
WiseTech's one we have mentioned, and it's a fascinating company, but it had a big bounce after its update at the conference. Yeah,
and they, again, didn't really move the goalpost too far, but I think, reaffirmed earnings guidance, said we're going to be at the top end. But then they had a big strategy day down in Melbourne. And I think the company, our market is still really only just getting educated on this business. And because it's so tightly held, I think a lot of fund managers have just left, pushed it to one side. But as that education process continues, I think, people are starting to realise the quality of this business. It's not cheap, but it's got huge growth potential.
Yeah. Aristocrat, good news there.
So I went to their strategy day last week, and they report in 3 weeks. There hasn't been any sort of financial update, but certainly it feels like the company's got a lot of momentum.
Well, that's good. The Invacare was a disappointment at the Macquarie conference. Their stock price has been really volatile for what you would otherwise say is a very stable business. Again, the reasons offered shouldn't have created that volatility, I don't think, Ben. But,
I'd agree. I mean, look, Invacare is going through a process of aggressive reinvestment over the next few years, spending $200 million upgrading a lot of their facilities. Well worth having a look at the presentation they released to that Macquarie conference just to get a feel for what they're moving their funeral homes from to. And I think clients will start to get a sense of why there's a big advantage in doing that. But, a poor death rate in the first quarter, Jeremy, of the year, which apparently hasn't helped their numbers in the short term.
Exactly. Talking about the big retailers, they both gave quarterly sales update. Woolworths flying still, 4% plus sales growth, fantastic. Coles didn't do too badly within the Wesfarmers stable, but it's not going to be in the stable for a long time. But again, it's hitting that in okay shape. A little surprise there. Yeah,
I still think the news of these two companies' deaths is greatly exaggerated. Everyone talking about Audi and Amazon, and ultimately these are still great businesses. Woolworths is clearly ahead and is moving ahead in leaps and bounds, and I actually think that's one of the two at the moment to own. But Wesfarmers is going to go its own path when it floats off Coles, and that'll be a much higher quality business as that happens. So it's just trying to work out, do you want to own Coles, and what's Coles worth on its own feet? There's some question marks there. And we might leave with mentioning a really great company we haven't spoken about before, and it's been hard to acquire. REH, which is in the plumbing supplies business and has made a really important big acquisition offshore in southern US. Ben, this is a company we've admired for a long time. And not a lot of people own or even know about it as a listed company. It gets very little coverage.
$5.5 billion, making a major acquisition now. I think this is going to raise its profile a lot.
I couldn't agree more. I mean, this is a company that doesn't get spoken a lot about because it is so thinly traded for a $5 billion company. And, the Wilson family, who still owns 76%, have done incredible things with the business. I'll give you an interesting statistic. I know we've got to go, but statistic, Jeremy. There's only 3 companies in the All Ordinaries who have never issued new shares since they listed on the market. And they're WH Soul Patts.
One of our favourites.
Nick Scarley, and REH. And so this is the first time REH has actually issued shares since it listed, how long? I don't even know.
Decades
ago. So I think they've done their homework. They're conservative investors, and I think it does look interesting as a transaction.
Yeah, so we'll update people about that when we get a little bit more, but it's the stock we've got in focus, and like many of those others, bring you those updates in time. We'll also bring you an update with our considered thoughts about the budget, and we'll be back in touch shortly.